Hello, and thank you for joining. We will begin our webinar in about 2 minutes. Thank you and stand by. Welcome everybody to Unit 21's Fraud in the Fast Lane webinar. I'm Jason Mikula, publisher of the FinTech Business Weekly newsletter. Today, I'm joined by Alex Fivasovich and Gil Rosenthal, and I'll be moderating today's conversation. FinTech Business Weekly is a once-a-week newsletter offering in-depth analysis on trends and stories in banking, fintech, and crypto, and fraud. Common themes include banking as a service, embedded finance, compliance, and regulation. So if you're interested, please subscribe. For those of you who aren't familiar, Unit 21 provides risk and compliance infrastructure that allows companies to ingest any type of data for transaction monitoring needs without writing code. They also provide case management to streamline your operation work and automation for SAR and FinCEN filing. Now, to our speakers. Alex, if I can ask you to please introduce yourself.
Yes, thank you, Jason. Hello, Gil, and hello to all our global audience. My name is Alex Fivasovich, fraud prevention practitioner for the past 14 years. My career started way back in Israel about 8 years ago, relocated to the United States. Did about 5 years of consulting, and 3 years ago, I finally transitioned into fintech. Today, I'm serving as the head of fraud risk here at Unit 21.
And if you want to give a brief overview of Unit 21.
Yeah, of course. So Unit 21, for those who are not familiar, is infrastructure that allows you to bring any type of data and use it for your transaction monitoring needs. So don't think about only transaction, think about non-transactional data, think about your KYC data, think about all the different vendors that you work with today. Your data don't have to be siloed anymore. You can bring all the types of data into one single platform and use it for your transaction monitoring needs. We have a very sophisticated rule engine that allows you to create very flexible fraud strategies. And we also have a case management solution, which allows the compliance team to work the different alerts, review the different cases, and automate SAR filing.
Thank you, Alex. And Gil, would you like to say a couple words?
Hi, Jason. Hi, Alex. Great to be talking to both of you again. I'm Gil. I've been working in fintech risk management for the past 13 years. Started my career at PayPal, where I was a risk analyst and managed risk teams. Then did 6 years at Bluevine, where I led the risk operation team. And I am now starting my own company called Quire, providing help with risk analytics to early stage fintechs. So if you're interested, check out getquire.io.
Awesome. Thank you, Gil, and thank you both for taking the time to join us today and share your expertise with our listeners around the world. Now, just a quick overview of the agenda that we'll be going through today. We're going to be talking through a number of different topics. So quickly, introduction and housekeeping. We're going to be looking at real-time payments and fast fraud overview, why real-time monitoring is so crucial as real-time payments become increasingly common. We'll walk through a couple of scenarios and monitoring strategies, and then do some Q&A. One last housekeeping item before we begin. We really want this to be an involved discussion and interactive session, so please feel free to use the Q&A button at the bottom of your Zoom screen to submit any questions as we go along. And as we get to the Q&A portion of the discussion at the end, we'll make sure to address as many of those as we can. So without further ado, let's get started. The growth of real-time payments, or at least payments that feel real-time, has solved meaningful pain points for a lot of consumers and businesses. Popular apps like Venmo and Cash App got their start solving relatively mundane problems like helping people split the check after going out to dinner or a night at the bar, replacing cash with an easier instant or instant-seeming payment mechanism. With the growth of both of those platforms and EWS owned and operated Zelle, consumer adoption, use cases, and the total amount of payments processed continue to increase. On the eve of the rollout of faster payment schemes like Clearinghouse RTP and FedNow, real-time payments inevitably will be used for more and more types of transactions. But real-time payments, like cash that they're displacing, are often treated as irreversible, indisputable. And as consumers and businesses increasingly migrate to these kinds of payment apps, so too do fraudsters. A challenge for consumers is they have a perception of safety when payments are processed through trusted financial institutions, but FIs themselves are looking to push more of this risk onto consumers through warnings rather than monitoring and prevention. Reg E, which implements the Electronic Funds Transfer Act, does include protections for unauthorized payments, but because many fraud schemes rely on tricking users, it makes it difficult to dispute those, with the banks saying that the users themselves have authorized the transaction. Now, there's a lot of bubbling interest in the regulatory apparatus in DC around sort of changing some of the liability rules. Zelle has been kind of a leader in thinking through what this could look like, but none of those changes have happened yet, leaving consumers exposed to a growing fraud problem. I'm sure everyone saw the Cash App story in the last couple of weeks, which only sort of highlights the risk to consumers as well as to companies operating these schemes. All of this is to say real-time payment fraud is a huge issue, and it's only likely to get bigger. So looking at our first topic, why is real-time monitoring needed? Alex, do you want to kick us off?
Yes, thank you, Jason, and thank you for this great intro to the history of real-time payments and where we stand today. But let's dig a bit deeper. So why is real-time monitoring needed? Frankly, we are not the first to ask this question. I think this question goes back to late 80s, maybe early 90s, where payment card issuers start asking themselves, we can no longer do pretty much reviewing after the fact. It's not sufficient. We're not really stopping fraud in a timely manner. What can we do? And this is where the whole idea of real-time monitoring came to life. And also around this time, the whole concept of rule engines came to life. So instead of having a team of analysts going through tons of paperwork, looking for transactions, trying to understand which transactions are high risk, you will have a rule engine that based on specific scenarios will alert on high risk activity. So the whole concept of flag and review in real time or near real time really came to life, let's say in the early 90s. Also around this time, the concept of first line of defense and second line of defense really was born. So pretty much the first line of defense will be the people who review the transactions in real time and take action on the transactions in real time. So for example, if we might want to decline a transaction or maybe put a temporary hold on the payment card, this is what the first line of defense will be responsible for. And the second line of defense will be more after the fact review, doing like a deep down analytics, understand how different fraud cases might be associated with each other. They're also the one who usually speak to the customers and try to do really deep investigation. Now, fast forward to the early 2000s, right? We've seen insane amount of digitalization. So we had the birth of e-commerce and we have the revolution of smartphones. And the concept of peer-to-peer payment was born. So basically, you no longer need to be a consumer to go and pay to a merchant or maybe to an e-commerce. You can actually start moving funds from one consumer to another. The pioneers, like you said, were pretty much PayPal. They were the first who came up with this concept. But what's really interesting is that the bad actors understood that there is a whole new payment method that now can be used. Not method, it's actually a new platforms that been born that we can use to move money from point A to point B. And the whole concept of do I need to go and steal someone's credit card is almost not valid anymore, because I can actually go and take over their P2P account. Or I can go as far as taking someone else's identity, or God forbid, create a synthetic identity and create my own account. And now I have an actual established account on that platform that I can simply use however I want to move money from point A to point B. And this is really where we saw the shift from monitoring mostly third-party fraud, which was the main focus in the 90s. Like, how do we protect the customers from third-party activity, from unauthorized usage of their cards, to slowly start to think about first-party fraud. Am I responsible for monitoring whatever's happening on my platform? How do I monitor the users who onboarded on my platform? How do I know that they're using my platform in the way I designed it to be used? And this is where we are today, pretty much. So today, fraud teams not only focus on third-party fraud, they focus also on first-party. And we emphasize the need of monitoring not only outbound activity, but also inbound activity. So you must understand how money flows in, and you also must understand how money flows out.
That's a really helpful context and overview. I mean, I think particularly, with the Cash App story top of mind, there's a bit of a perception that fintechs either have or willingly tolerate more fraud than traditional banks, traditional financial institutions. From where you sit in the clients that you work with and sort of what you see in your day-to-day work, do you think there's any accuracy to that perception?
I think it's not really about tolerance, but it's about understanding the concept of fraud. So what is fraud? How do I measure fraud losses? And I think fintech have slightly different views on how to treat fraud, how to calculate fraud, and how to understand what are my fraud losses and what am I actually liable for, than what we used to see with traditional banking.
Got it. Gil, I'm curious to hear your thoughts. How does the shift to faster payments, to real-time payments, change how institutions need to go about monitoring and mitigating fraud risk?
So I think that's a great question. I want to, first of all, agree with everything Alex said before. And the main thing I 100% agree with is that real-time payments are not new, even to financial institutions, right? Like the debit rails have been real-time for forever, right? ATM transactions have been real-time for forever. And outside of financial institutions, other institutions have been handling real-time payments for a very long time, including the credit card industry. Most of e-commerce defenses are being built in real time or near real time, right? So there's a lot of parties in the industry to learn from and to basically see where we are going. I think what financial institutions need to keep in mind are two main things. One is that with real-time payments come more scaled attacks, okay? Because real-time payments allows fraudsters to move fast, allows them to react very quickly, to identify gaps in defenses, sorry. That encourages them to have more scaled attacks because there's no second line of defense. Once they find that first hole, they power through it as quickly as they can. And that is why real-time monitoring is critical, because the scale of attacks and the speed of attacks that I've seen at PayPal, for example, was completely different than what I've seen financial institutions have to deal with, just because of the speed of the event, right? How quickly money moves from one party to the other party. I think the other thing that financial institutions need to keep in mind is that with real-time payments comes not just bad actors, but also comes the expectations of good actors, meaning good actors are now going to expect the same level of service, the same level of customer experience that they are experiencing in what they are familiar with as real-time payment capabilities that they have today. So they will expect a customer experience similar to what they have in Venmo or in Cash App or in Zelle. And those were built to have very, very smooth and clean and good customer experiences. So while you can't compromise your defenses for it, you have to adjust to it. You have to prepare not just your fraud defenses, but also your customer experience for it. And that again ties to the ability to do real-time monitoring and react very quickly. You can't figure out that a bad activity happened on someone's account 3 days later. You can't block someone's ability to transact for 3 days. You have to react much faster to any signal that you're identifying.
I think that's an excellent point. I mean, my operational background was in consumer lending, where most of the payments were dispersed via ACH, right? So you did have a window to try to sort of screen and stop transactions before that cash went out the door, and actually even sort of a longer window to try to claw that money back, versus in a real-time payment world, once it's dispersed, once it's moved, it's gone. I mean, I do want to move on to talk about a couple of real world scenarios. I mean, building on the context of sort of the history of real-time payments and why real-time monitoring is critical, let's talk about some sort of like concrete examples of fraud scenarios, both established ones and sort of emerging or up and coming ones. Gil, if you want to talk us through a couple of these established fraud scenarios.
Sure thing. So I think the first scenario is scams. This is extremely prevalent with products like Zelle, right? Where bad actors, and this ties to what you said before, Jason, which bad actors are trying to shift the liability. So they want to get the actual consumer or customer to be the one issuing the real-time payment transaction as much as they can. They're doing that because that creates confusion in the system. Once you do that and you figure out that there was a problem, you report it to your financial institution. Your financial institution is a bit suspicious because you've done the transaction. And that creates an additional window for the bad actor to move the money out, to be able to keep control of the money. With real-time payments, there's a lot more incentive to do this because there's that lack of ability for the financial institution to freeze the funds, to claw back the funds, just like you've mentioned before. So the scams is definitely something that with more real-time payment products, financial institutions are going to experience that more. And that requires some adjustment to the defenses to be able to understand that sometimes your customers are not the bad actor, sometimes they're the victim, and you have to react to it. The second scenario is exit and intermediary accounts or layering. This is something that I've seen happen a lot to Cash App, because these are in many cases open networks. So for example, FedNow, right? Like I can send from one bank account to another. You have less control over who is the receiver and how legitimate is the receiver. And the way our industry, the financial institution industry, has set things up is that you don't get confirmation from the receiving financial institution, oh, this is a well-trusted receiver, you're good. right? That's something that in Europe, they're trying to adapt a bit more, but that confirmation is still not a part, definitely not of the US ecosystem. That means that for bad actors, they only need to find one financial institution that is a part of this network that allows them to easily open accounts that are under fake identities, under synthetic identities. Alex talked about these before. Once they find that, they can start funneling money to that very, very quickly from other types of bad activity. So creating monitoring, not just on the transaction level, but also on the account opening level and on the account level as a whole, and the receiver, as Alex mentioned before, are all very important.
Yeah, if I can touch on the third scenario, and in the context of what Gil just shared, really, when fraudsters and bad actor groups understand that, hey, this network can actually be a great vehicle for me to conduct fraud, what they will do is they will, like Gil mentioned, they will look for the weakest member in that network, and they will try to exploit it. Everybody talking about how fraud is evolving, and before fraud evolving, it's shifting, right? So fraud will keep shifting until the opportunity to utilize that vehicle is fully exhausted, and only then it will evolve. And you must understand that if you're part of some type of network, whether it's real-time payments, P2P, or whatever network it be, you cannot be the weakest link, because if you are the weakest link in that network, you are the financial institution that will be constantly under attack. Now, even though we shifting our efforts from third-party fraud to more first-party fraud, it's also important to remember that it's our responsibility to protect our customers at the end of the day. And even though card fraud is declining because the heavy adoption of smart chips, we still see a lot of card not present fraud, and it's pretty much still on the rise. And it's on the rise for a simple fact, because fraud today is it's cool. Everybody wants to be a fraudster, and it's so easy to become a fraudster today. 10 years ago, it was more challenging, but today all you need is a Tor web browser, a few hours of educational YouTube videos, and that's it. You're ready to go. And the easiest way to start fraud is really to go on a marketplace, buy yourself a bunch of compromised credit card numbers, and go out and shopping. So pretty much it's our responsibility also to keep in mind that, yes, we are very much concerned with first-party fraud, and we want to make sure that we don't have bad actors on our platform, but we need to keep in mind that we still have a good amount of good customers, and it's our responsibility to protect them.
Yeah, as far as how easy it is to start scamming, I'm always astounded at the content that shows up places like YouTube or TikTok that are essentially like instructional guides on how to defraud unemployment insurance or PPP loans or what have you. I mean, it's pretty brazen, and I think particularly during the pandemic, when a lot of people were at home and maybe didn't have much to do, and also maybe were out of work and needed money, there were some pretty perverse or pretty strong incentives to engage in some of this activity. Plus the feeling of, oh, well, everybody's filing fake unemployment claims and getting money, getting rich. Why shouldn't I do it? Hopefully that's moderating a bit as we come out of that era. But fraud continues obviously to be a very pervasive problem. I did want to ask a couple of follow-up questions on the scam side. For romance scams, for example, are there concrete steps that FIs can take to help protect their customers or mitigate the risks from these kinds of scams? Gil, is there any context you can provide on that?
So, yeah, I mean, there are definitely steps that can be taken. I think the first step is building, like we've been talking about, real-time monitoring to identify potential suspicious transactions, right? Because these scams usually happen to your existing customers. They seem legitimate, they seem fine, right? But identifying that legitimate customers are acting abnormally is a very important first step. A second step is having not just upfront warnings, because most scammers know how to work around the upfront warning and the potential, and a lot of them know how to work around educational material that you provide ahead of time. You need to have the right process after the fact to react very quickly, to decide what are you going to do, to have set policies so that you can create the right customer experience for people who have been victimized. And you have to keep in mind that those are victims. I think one of the main things that got people very, very upset with Zelle was that the financial institutions that were using Zelle were reacting to scams like this as if the person, their customer, wasn't just a victim of a victim of theft that used their platform for that process, right? If you treat it that way, then that creates a whole bunch of new problems that you don't want to have to deal with, which is very, very, very angry customers. They're offended by your financial institution, not just by the person who scammed them out of money.
Yeah, I mean, I think that's a great point. And, you know, I suppose I have a little bit of sympathy coming from the FI world where, you know, if a transaction was authorized and appears to be legitimate by the customer, you know, how do you know whether they were truly scammed or tricked, or, you know, how do you not know that they're lying to you and trying to dispute this, and really they sent that money to their friend? And so in that sense, you have a little understanding of where FIs are coming from, but absent, you know, some liability shift that forces, you know, banks or P2P payment app operators to bear some of the negative repercussions, you know, it seems unlikely that you're going to see significant change. I did want to ask a second follow-up question to something, Alex, that you mentioned about account opening. I mean, I know that when my identity was stolen, it was used to open all sorts of bank accounts. And you know, the person or people who were doing this, presumably, you know, didn't have a copy of my driver's license or passport. They just had sort of the core identifier information. Account opening seems to be a really key point where fraud can be caught or can be missed. I'm wondering what additional steps FIs can take to help catch fraud at this sort of critical account opening juncture before that person is able to sort of obtain and operate an account that can be used to perpetrate fraud.
Yeah, that's a great question, Jason. And I think to your point, when it's important to understand that when your identity is being compromised, it's like you said, it's usually doesn't end with, you know, one checking account that was open in your name. The bad actor who owns your identity now will go after everything you got, and then will try to create as much new accounts and wallets and everything that they can create until they feel like, okay, this identity is fully exhausted, just to maximize the ROI. But to your point, what institutions can do to have a better control at account opening, I think, first of all, if you are a fintech in a hyper growth state, understand who's your base customers, right? Who do you expect to come to you in, let's say, a very organic way, right? And separate the organic channel from the channels that is paid acquisition, right? Usually when bad actors will try to onboard to your platform, they probably won't waste their time clicking on, you know, your Instagram ads or going to your TikTok channel. They will just go to your onboarding page and will start onboarding directly from your landing page. And once you understand that you need to look at onboarding fraud differently from organic customers to paid acquisition customers, it's easier to differentiate, okay, whether those organic applicants that coming to me right now, do I really expect them to come? Is, you know, the age criteria, the geolocation where they at, that doesn't meet the product fit. With paid acquisition, it's also important that we as fraud leaders collaborate with the people who are responsible for growth at the fintech, right? So work with your growth manager and understand together what we expect from a paid campaign, what type of applicants we expect this campaign will bring, and monitor to make sure that whatever money the growth manager is spending, they're actually spending on good customers. But not only that, once the campaign is finished, it's important to keep tracking those customers that came from a specific campaign and really understand 6 months later, or maybe 1 year later, the true lifetime value of that campaign, and whether or not maybe, you thought you onboarded 1,000 amazing customers, but they ended up as 900 closed accounts due to confirmed fraud. And make a conclusion and come back to the growth manager and tell them, hey, this campaign that we launched last year, there's no more good accounts left from that campaign. Everybody ended up as fraudsters. I think it's important to create this collaboration between growth and risk. We are not competing with each other. I always say, if I'm the risk manager at a fintech, I see myself as a designated driver. You go, have fun. I'll make sure everybody gets home safe.
As somebody who spent many, many millions of dollars on marketing campaigns and was optimizing, thankfully, I was optimizing towards like CAC versus LTV. And so the companies I worked at did have that dialogue between growth marketing and credit risk and fraud risk to make sure, hey, if we've onboarded a zillion new customers from this marketing campaign, let's make sure that they're real and profitable and not fraud. So definitely appreciate where you're coming from there. I want to transition and talk about a couple of emerging fraud scenarios. So we've heard some about established fraud scenarios where real-time monitoring comes into play, but I want to hear about what you guys are seeing out there in the field as sort of emerging strategies or emerging risks. I mean, Gil, do you want to kick us off with a couple of the scenarios that you've been seeing lately?
Yeah, so I've seen a few scenarios that I think are starting to become more intense. The first one is not necessarily fully emerging, right? It's been around forever, like the friendly fraud or liar buyer, where someone says that a transaction they have done isn't theirs. But I think what I'm seeing is that it is shifting in its behavior. Both it's becoming a lot more prevalent, but more than that, with the emergence of real-time payments comes a lot more incentive for users to be able to say this once on a fairly large transaction, to get a one-time cash basically incentive for this, and it's something that FIs should be cautious about. Again, that's the flip side of the scam, right? Like do you trust them? Do you not trust them? But you have to be cautious of both sides. The other one that I've been seeing is what I've been calling short-term credit manipulation, but it's basically when there's a real-time payment transaction after you get an advance from a financial institution for a slower payment inbound transaction. So you deposit a check, that check will clear in somewhere between 3 to 5 days, actually. But a lot of times your financial institution will give you that money, access to that money right away. Then you immediately move it out through real-time payments. And by the time that the check bounces, suddenly the money isn't there. Same thing with ACH, right? So the quick follow transactions through real-time payment channels, again, it's something that existed before with wires in most financial institutions. And those are defenses that were built specifically in wires. A lot of times in your wire monitoring, you'll be checking if there was a payment received recently through a slower process. But this is becoming more prevalent, and financial institutions, definitely with the emergence of FedNow and other real-time payments, should be more cautious of it.
And Alex, mastering the friction, what is that scenario? What does that mean?
So I decided to talk about this scenario from the fintech side of things. So rather, talking about what scenario is emerging in real-time fraud, I want to talk about what scenarios should be emerging at fintech companies. And when I say master the friction, product teams go out of their way, design the perfect customer journey. every click in the app, everything that the customer does should be perfect. But I believe that if you are engaging in real-time payments, and it's important to also design a very good journey of how you will protect your customer and how the customer will actually be engaging in real-time payments on your platform. So, for example, if we say that if the customer sends a payment, once he clicks the button, there's no turning back, the money is gone. How can you make that journey with slightly more friction, but get the customer feel safer? So maybe instead of click of a button, it could be a slider. It will take maybe half a second more to send the payment out, but get the customer thinking, do I really want to slide all the way down to send the payment to that person? Friction is not only sending the customer a text message, or friction is not only declining a transaction. You can embed a lot of creative friction within your platform to really get the customer the sense that he's not only transacting in real time, but he's actually being protected in real time. And once you do identify that something bad is happening, there is a potential fraud, like Gil mentioned a few minutes ago, you can no longer hold someone's payment method for 3 days, keep it frozen until you understand what's going on. You really have to understand how you put a hold on the account, how to investigate the right call to actions and right engagement with the customer. Because today, if you don't master the friction, and if you don't master your fraud investigation really, really fast, your customer will leave you and they will just move to the competition.
Got it. I mean, now that we understand emerging risks, established risks, we probably need to talk about how we can use real-time monitoring strategies to detect and mitigate these risks, both to the FIs, banks, fintechs, as well as to the end customers. Gil, what are some of the best practices that fraud teams can use to effectively combat fraud in real time?
So the way I see it, financial institutions' defenses are built at 4 main checkpoints, right? At account opening, post-account opening, so at the time of transaction, so that would be either outgoing or incoming transaction, and post-transaction. And financial institutions should be building their defenses in all 4 layers, right? The best real-time monitoring you can do for a suspicious transaction is actually catching the bad account opening before they even receive the transaction, getting all of those flags in, or ideally stopping them before they were able to open the account. So building defenses at those layers is very, very important. Once there's a shift to real-time payments, the importance of real-time transaction monitoring becomes a lot more critical at the transaction level, to be able to identify both incoming transactions and outgoing transactions that have any signal of suspicious activity. So I think the best way for me to explain this is with an example. So let's say I am an account holder, and that you, the financial institution, know that I'm legitimate, and I try to send money to a known bad actor, someone that you have already identified has an account with your bank account with your financial institution, is a known bad actor. In that situation, at the time of the transaction, you can have the monitoring to identify that the receiver of this transaction is problematic. You can flag this, you can stop the transaction, or you can act quickly enough afterwards to be able to stop the money at the receiving side of the transaction, right? So you have various levels of control to implement. I think that's the crux of it, is build like layers of defenses and don't focus on a singular point. And in those layers, try to incorporate as much of the information as you can. Your information doesn't just stop with the transaction itself. It doesn't just stop with the identity of the sender. You also have the receiver. You have information about the who is issuing these funds and when and how. And all of those can be incorporated into smart transaction monitoring capabilities.
The idea of layering different kinds of defenses is interesting and definitely seems relevant and perhaps somewhat of a shift from how institutions may have approached this when stuff was more batch payments, where they had sort of a longer period of time to deal with it. Alex, can you tell us a little bit about how Unit21's customers are using these kinds of layering approaches or the capabilities that Unit21 provides to monitor transactions and other kinds of data in real time?
Yeah, absolutely. And to your point, Gil, really, I think your approach should be set in stone. There's no other way around it. And you cannot cut corners, right? You have to have controls at the 4 points of time you just mentioned, because if you don't, you'll lose the battle. But pretty much what we try to do with Unit21 is to allow our customers to create monitoring that, just like Gil mentioned, not only focus on a specific transaction or a specific event. One of the unique ways to look at Unit21 is that we look at each entity in Unit21 as both a sender and a receiver. So for example, if you design your product in a certain way where you expect your customers to fund their account with a certain payment channel, you need to consider how do you expect the customer to actually go and spend that money and what payment rail they will use to spend that money. So if somebody chooses to fund their account for $10,000 and suddenly they go to the real-time payment rail that you provide and they try to funnel out 90% of that amount, does it make sense from product standpoint, right? And by looking at entities, both as senders and receivers, we allow our customers to really create more sophisticated monitoring rules that help them flag high-risk customers. But I think also the way we look at the evolution of monitoring in Unit21 is we really divided into 3 different levels. So level 1, as you can see here on the screen, is very manual, is usually where more companies start. And it's usually involve around a lot of different, either Excel spreadsheets or maybe some type of execution of SQL queries or what have you. And then with level 2, you have most of the time some more sophisticated in-house built rules and maybe additional point solutions. So maybe you decided to bring a device risk vendor that will help you identify high-risk devices. Or maybe you start working with a much more sophisticated KYC vendor and you try to understand how to utilize this data. But really what we try to do with Unit21 is to bring all of our customers to level 3. Where they can bring all the transactional data into Unit21, they can bring all the non-transactional data into Unit21, and start creating a really sophisticated risk and compliance infrastructure. So once you look at all the data you have from a very holistic approach, it's much easier to go and start building strategy that it's not like, hey, there's a 10,000 of transaction of $10,000 money moving out of the account. Let's see what happened to this account. Let's see who that account is, how long they've been banking with us, what the activity that happened before in the past 2 hours, 6 hours, 12 hours. What do we know about the historical usage of that customer? Can we apply any AI or machine learning insights to understand whether or not this transaction is risky? And this is pretty much how we treat our customers and how we help them design their fraud strategy.
Thank you so much for that, Alex and Gil. Fantastic program so far. I mean, to me, it seems like some of the key takeaways are that real-time payments mean sort of inherently scaled attacks in the sense that once fraudsters identify that vulnerability, they have every incentive to exploit it as ruthlessly and quickly as possible to get as much value, as much money out before it's patched. That real-time payments introduces a new and different set of incentives and risks both as far as third-party fraud, but also first-party fraud. And that in thinking about how to tackle or mitigate these risks, FIs, banks, fintechs need to be thinking in terms of stopping it at different points and thinking in terms of layers of behavior, layers of defenses, and also understanding how senders and receivers are behaving across a network. I think now we have a poll for folks attending the webinar that should pop up. While we're waiting for the poll to conclude, I'd like to remind everyone to submit any questions. I think I already saw quite a few in there, and we have a good 15 minutes to talk through those. Also, a reminder that we'll be sending a recording of this webinar to all of the attendees within the next day or so. Please feel free to share the link with your colleagues. And like I said, we have a bunch of questions, so we can see how many of those we have a chance to address if we want to shift over to the Q&A. And it looks like our first question is, why are US banks or core providers reluctant to collaborate on fraud with things like central or shared identity validation, account good standing, etc.? It is very selfish / short-term model that does not protect US consumers. I can definitely testify that that has been my experience as a consumer who had to deal with a lot of banks when my identity was stolen. Alex, do you want to kick us off on that question, and then we'll see if Gil wants to add anything?
Yeah, sure. So I think I have two answers to that. The first one is different banks see fraud in different eyes, right? Different banks identify fraud differently, and sometimes, if you think about collaboration, and you might think, okay, if I collaborate with you, but you identify fraud or you suffer from a different type of fraud, what do I get from this? But on the other hand, we do see collaboration between financial institutions. I mean, consortium products have been around for many years. The most notorious one is probably early warnings, which was created by the biggest banks here in the US. And recently, we with Unit21 actually launched the FinTech DAO, which is more focused on consumers who might choose a fintech product rather than go to a traditional banking institution. So we do see collaboration, but there's also always a question of how big I am as a financial institution compared to the consortium that I'm about to enter, right? If I'm a huge bank and I enter a brand new consortium, what's in it for me? Because the model is give to take, right? On the other hand, if I'm a small fintech which is getting started and I'm entering a huge consortium full of huge organizations, that's amazing, but I don't have much to give. So it's a tricky relationship. I do see consortium products and cross industry collaborations definitely in the future of fraud prevention. But I'm personally encouraging all financial institutions to take a look. That's definitely would be helpful.
Gil, anything to add before we jump to the next question?
I think generally I fully agree with Alex. I'll just add that if you think about the difference between Europe and the US, for the most part, it's that in the US, and I'm not going to go into the reasons, but the regulator doesn't require the same level of cooperation between financial institutions, which means it is more a free market type network that needs to be built, consortiums that need to be built, which is why I believe there's less cooperation.
Yeah, I mean, there's all sorts of sort of game theory and economic problems that make consortium building difficult, even with early warning, which Alex referenced. It's like you do see these sort of tensions between big banks which own EWS, smaller banks, community banks, etc. I'm sure I could talk about that all day, but let's go to another question. Most of the transaction and fraud monitoring solutions in the market seem to implement some controls on the receiver side, but not much is seen while sending out payments which seems to be critical for the real-time payment channel. So basically having the sender monitoring and being able to sort of mitigate risk there. Does Unit21 tackle this challenge? If so, how? I guess that's also an Alex question since it's specifically about Unit21. Sorry, Gil.
Yeah, of course. So, and I think it's slightly the opposite. Now, if we historically look at, what is transaction monitoring, we used to monitor outbound activity, right? Somebody pays with a credit card, money leaves their account. We start transaction monitoring with that. And like I mentioned earlier, the reason why we created 3 levels within Unit21 of monitoring. So basically, you can monitor either on an entity level, on an instrument level, or on a transaction level, and treat each level is either a sender or a receiver, or in some scenarios, both. This is pretty much why we emphasize the importance of monitoring the money movements in and out. And this is how we do it with Unit21. For whoever asked that question, I don't see names on the screen, but feel free to book a demo, and we'll be more than happy to show you how we treat this problem.
Hey, it's interesting. I mean, again, thinking about some of the Cash App story from whatever a week or two ago, where you see how money moves in and out of multiple nodes through this network, right? So you need to be watching both pieces of it to sort of like effectively understand how are funds moving through this network or moving through this like series of interlinked accounts. Okay, next question. And we can start with Gil this time. What are the most important steps financial institutions and fintechs need to take before adopting real-time payments to ensure they avoid rampant fraud? Which I think is like a huge and very relevant question, given the pending launch of FedNow in sort of consumer-facing applications that presumably are going to be built on top of that. Gil, most important steps?
I think the most important steps are product steps and not risk steps. There are 2 main product steps that you have to think about first, which is who gets access to this and what are the limits that you're putting on it, right? And if you do those the wrong way, you give everyone access with no limits, fraudsters will come running. And even if you put controls behind the scenes, you will have a hard time keeping them out. If you put the right limits of how you can use it and where you can use it and who can use it and who can you send money with it to, and you create the right controls, and then you open it up gradually and you give more access, the more trust you have with your senders, with your receivers, then you are setting yourself up for success. That is something that I would recommend in any financial institution to take with your product teams, to take with your business teams, to ensure that you're not starting from a very weak point. After that, there's, like we said, I think transaction monitoring is going to be critical, and changing your process to being as close to real-time transaction monitoring as you can.
The point about who you give the capability to is interesting. I mean, I know a chartered neobank recently added Zelle, and if I recall correctly, they're only giving that feature to customers maybe who have like direct deposit. So they're basically adding already a filter that's like, okay, we want to see your payroll coming in, frankly, probably more than one time, probably, multiple sequence before they give them that Zelle capability. Alex, anything to add on that, on the question, most important steps for FIs to take before adopting real-time payments?
I will circle back to mastering the friction, right? So you design a product, you design who are eligible for real-time payments. Okay, you start monitoring it, but what's next? You come across high-risk payment. What do you actually do with it? How do you stop it? And if you stop it, what are the follow-up steps? Do you contact the customer? Do you put a hold on their account? You don't master the friction, chances are those qualified customers will probably stop using this product.
Got it. Awesome. We have time for a couple more. Can you share what are the typical use cases or tools used by compliance teams to monitor for possible fraud and act on it? Presumably in addition to Unit 21, Alex? Typical use cases or tools.
The use cases and tools are very traditional, right? It's good, healthy transaction monitoring. It's creating flexible, above the line, below the line strategy of how you monitor different types of accounts. It doesn't become super complex, let's put it that way. But what we try to do when we try to create efficient compliance programs is really, first of all, you have to make sure that you're compliant. So the very basics of whatever jurisdiction you're operating in, you're actually meeting the regulations. And then we also try to tweak in terms of, true positives, false positives, what are we actually doing? How much of impact do we have on the compliance team, making sure that they're working efficiently, making sure that the workflows make sense, making sure that it's easy for them to create a narrative and follow the narrative, and if they need it, file stars eventually. So this is what we try to help our customers and how we guide them with Unit 21.
Got it. Gil, really quickly, any typical use cases or tools used by compliance teams to monitor for possible fraud and act on it?
I think the things Alex mentioned were perfect. And I know you said outside of Unit 21, but seriously, you should check out Unit 21.
That is a perfect segue to our last question, which is, we love Unit 21. I did not write this. You guys have fans and are so excited to hear about your real-time fraud monitoring. Can we run any transaction rules in real time? Are there any limitations? Alex?
Yeah, so thank you so much for sharing the love.
They want a t-shirt.
Yes, of course. But I think if we take a serious look at the question, yes, of course, we can ingest any type of data, any type of transactions, and we work with every customer to make sure we meet their SLAs, but also reflect the true capabilities of our tool. I think this is a question that have a lot of details, both on Unit 21 side and customer side, but we would love to address that. If you're already a customer, call us, email us, and if you're a prospect, just book a demo. But we are more than ready to help you track real-time payments.
Fantastic. That is all the time we have for today. Everyone who's on the webinar, thank you so much for joining us. Gil, Alex, thank you so much for sharing your experience and insight. If we did not get to your question, the team will follow up with you directly. If you'd like to speak with us further, you can visit the Unit 21 website, ask for a product demo, read more about it. You can also reach out to me directly at fintechbusinessweekly.com. I'm always happy to chat and get you in touch with the right folks at Unit 21. Most importantly, like I said, want to thank Alex and Gil for their time and wisdom. Thank you again so much for joining us today, and enjoy the rest of your day.
Thank you, Jason. Thank you, Alex.
Thank you.
Thanks, guys.